It has been a busy week for U.S. economic data. The dollar's 9-day drop, the Fed chairman's first direct press conference, and numerous opinions, official and unofficial, on the deficit. Our next guest is known by many as the de facto chief economist at Congress. Mark Zandi is with us. He is the chief economist at Moody's Analytics, and he is with us now from Westchester, Pennsylvania. Mark, thanks for joining us here on the Inside Track. We have our reporter, our chief Washington correspondent, Peter Cook, in Wisconsin, tracking how people there are responding to their hometown hero, and for some anyway, Paul Ryan. What kind of compromise do you think would be best for the U.S. economy?
Well, I think there's reasons to be optimistic there will be a compromise. I think everyone's coalescing around the idea that we need about $4 trillion in deficit reduction over the next decade, that most of the deficit reduction has to be focused on spending cuts and not tax increases, that on the tax side we can focus on broadening the tax base by reducing tax expenditures. So I think if there are a few obvious stumbling blocks, Medicare being one of them, but I think the fact that we're finding an intellectual consensus here is a very positive development, and ultimately I think it means we're going to come to some kind of reasonably graceful resolution on this problem.
Mark, I'd like you to take up a phrase that we keep hearing in the deficit debate, and that is pro-growth fiscal reform. In the very short term, let's say in the next couple of years, is there such a thing? Is it even possible?
Yeah, sure. I think if Congress and the administration agree to a clear and credible path to deficit reduction over the next decade, over the next 12 years as they're discussing, that would be very pro-growth. I think global investors
but Mark,
would take heart.
Pro-growth over what period of time? Pro-growth 10 years from now or pro-growth 12 months from now?
Immediately. I mean, I think investors would view that very positively. Interest rates would remain low, the cost of capital low for businesses so that they can invest, interest rates for mortgage rates for potential homeowners low so they can buy homes. So I think that would be very pro-growth. Now, it would, I think, be ideal if this clear and credible path didn't impose too significant of an austerity too soon. I don't think we need to do that, and I think that could undermine the weak and fragile recovery. But, I think a clear and credible path will reap benefit immediately.
Mark, the U.S. dollar is down. We're watching on our Bloomberg screens right now 9 days in a row. Where does this fit in, especially as far as the inflation debate is going?
Well, I think the weaker dollar, the decline of the dollar has been very orderly. It's been modest in the grand historical scheme of things. I mean, if you look back, the dollar today on a broad trade-weighted basis is about where it was 3 years ago before the financial crisis. And it's entirely appropriate. I mean, I think the U.S. economy is still weak relative to the rest of the world, and that would argue for a softer dollar. And
really, Mark, though, the U.S. economy is weak, I mean, compared to the Eurozone, for example, compared to Japan?
Well, against the emerging economies, which are over half global GDP, yes. The emerging economies are growing very quickly. They're operating at capacity. They have inflationary pressures that are much more developed than here. So you would expect the dollar to fall in value against all of those emerging economy currencies, the yuan, the Brazilian real. Now, against the other developed economies, particularly Europe, yeah, I think there is an argument that the dollar against the euro is not where I think it's going to be in the long run. But, the Europeans are tightening monetary policy. They're ahead of the Federal Reserve, and economic theory would argue that the euro should be strong in the context of those different monetary policies.
Mark, is there a point at which the balance tips against the economy? In other words, the salutary benefits of a weaker dollar for exports, say, are more than overcompensated by the impact of higher oil prices, higher grains prices, higher industrial metals prices priced in dollars?
Yes, there is. I don't think we're there yet. I mean, I think the run-up in commodity prices is in part due to the weaker dollar, but I would put that way down on the list of things that are driving commodity prices up. I mean, in the case of oil, it's Middle East unrest. In the case of many other commodities, it's strong global demand for those commodities, particularly from those emerging economies. These markets, these commodity markets, are financial markets. So I think speculation and investor demand is creeping in some of the markets, some of the precious metals markets. So the dollar has played a role there, but I think it's a very, very modest role, at least compared to these other factors. But yeah, there is a tipping point, but I don't think we're there yet. I think the weaker dollar, the orderly decline in the dollar on net, has been a plus and continues to be a plus for the U.S. economy.
The deficit and the dollar. Mark, Zandi, two good topics to have you on this morning. Thank you very much.